Hello and welcome to the Lolly Investor Programme. I'm in Covent Garden at the heart of London's West End to talk about the last item on my short list of savings plans that I don't like much. Today I'm talking about the investment bond, which I'm afraid is an example of how the financial services industry can put its own interests ahead of its customers. The big problem with investment bonds is that they are basically inferior to ISAs and pensions. If they had seats at the Opera House behind me, they'd have the cheap tickets right at the top of the gods, with a view half obstructed by a pillar. Nevertheless, billions of pounds have gone into investment bonds over the years, not because they are the best savings plan that money can buy, but because investment bonds pay advisors who sell them more commission than other financial products. In other words, many people have ended up with investment bonds because it suits their advisors more than it suits them, and that makes me cross. Before I go any further, I should really clear up some confusion over the word bond. There are in fact three types of bond in finance, and it's important not to mix them up. First of all, there are the bonds that governments and companies issue when they borrow money from investors. These are one of the main asset classes, alongside shares, property and cash, that we looked at earlier in the series. I'm not talking about those bonds today. Then there are savings bonds. These are a form of savings account for your cash. The main difference between a savings account and a savings bond is that you usually have to lock your money away into a bond for a few years. Savings bonds are sometimes known as fixed rate bonds because they often pay a fixed rate of interest rather than a variable rate that will go up and down. I'm not talking about those bonds either. The investment bonds I'm talking about are a mix of life insurance policy and investment plan. The life insurance part means that you can select an amount that will be paid out to your partner or family should you die during the term of the bond. The investment part means you can choose from a range of funds in which to invest your money. This makes them similar to ISAs and pensions, which, as we saw before, allow investments wrapped up inside them to grow pretty much free of tax. In my world, if the stocks and share ISA was fish and chips and a pension was kebabs, then an investment bond could be a crepe to roll around your money. Only, unlike this beautifully made crepe, the investment bond crepes are, well, a bit crepe. They've got holes in them. They're overcooked on one side and they're undercooked on the other. By this I mean that the investments held inside a bond are taxed more than if they were held inside an ISA or a pension. This means your money won't grow so fast. Another pitfall is that because of the commission that's paid to advisors selling the bonds, many bonds have expensive charges if you want to leave them early. However, I don't want to dismiss investment bonds entirely. They do have one big tax advantage to compensate. You can withdraw up to 5% of your original investment a year without paying any more tax. This can create tax planning opportunities. For example, an individual can start an investment bond when they may be paying higher rate tax, but time their withdrawals until they retire when they may be on the lower basic rate of tax. You can also buy investment bonds from insurers based in offshore centres like the Isle of Man or the Channel Islands. Money wrapped up inside an offshore bond will grow free of tax. However, buying an offshore investment bond is taking you into serious tax planning waters, so you should only do so under the advice of a properly qualified financial planner. So that's it on investment bonds. As a tax planning tool, they have their uses, but as a simple place to save for the long term, I think ISAs and pensions are better.